Good morning, everyone. Thanks for joining us today. I'm Teresa Yardley, Head of PI at NBS, and I'm delighted to be joined today by Sam Moore, who's a Managing Partner at Caytons Law. Professional indemnity differs from many other classes of insurance, particularly in relation to claims-made cover and notification requirements. Today's webinar will explore some of the key principles and common issues that brokers should be aware of when advising clients and making PI notifications. Our appetite for PI at NBS spans a wide variety of professions, from traditional sectors such as accountants, architects, surveyors and engineers, through to insurance and mortgage intermediaries, IT consultants, and a broad range of miscellaneous professions. Whilst the professions themselves may differ, the principles we'll be discussing today around claims-made cover, notification, and fair presentation are relevant across all of these professions and are issues that we regularly encounter when supporting brokers and their clients. One of the reasons we wanted to run this session is because PI insurance operates differently from many other commercial insurance products. The concepts Sam will cover today, such as claims-made cover trigger, notification of circumstances, and fair presentation, can have a significant impact on how a policy responds. Having a good understanding of these principles can help brokers identify issues early, support clients more effectively, and avoid potential coverage disputes further down the line. As our specialist claims management and legal services partner for our PI product, Caytons work closely with NBS to support brokers and insureds when claims and notifications arise. And we're delighted to have Sam with us today sharing his expertise. I'll now hand over to Sam.
Okay, thank you very much, Teresa. Hi, everyone. I'm Sam Moore, Managing Partner at Caytons. So, as Teresa said, I'm here to sort of talk to you about claims-made policies and notification requirements, and we're also going to get on to fair presentation, which is an obligation under the Insurance Act. But firstly, in relation to professional indemnity policies, as Teresa has said, they are fundamentally different to other commercial insurance products that are available because PI policies are written on a claims first made basis. So what does that mean? Well, firstly, it's necessary to understand what is meant by claim. Different policies will define a claim in sort of different ways, but broadly it will mean sort of a demand made of or an assertion of a right against an insured, where the claimant is essentially seeking sort of civil compensation or damages. And for PI policies, the policy that is triggered will be the policy that is enforced when the claim is made, irrespective of when the mistake giving rise to the claim is made. Now, a number of PI policies are triggered on just the claim first being made, but there can be an additional requirement for the claim to be first made and notified during the period of insurance, typically in construction-related policies. Now, whilst PI policies are written on a claims-made basis, there is an important extension of cover where PI policies will allow policyholders to notify circumstances, which are things that don't quite amount to a claim, but typically have the scope that they may result in a claim or likely result in a claim. I'll come on to that distinction in a bit, and that's a fundamental that's a fundamental importance for PI policies, because if you can't notify circumstances, you could have a scenario where the insured doesn't quite have a claim in one policy year, so it won't attach to that policy, but then the insurer coming onto risk will typically have a known circumstance exclusion and say, well, there isn't any cover because it arose before the policy incepted. So by allowing to notify circumstances, there will be a deeming provision in the policy that says any claim that subsequently arises out of that notification is deemed to be first made during the policy period in which the notification of circumstances took place. Now, occurrence-based insurance is fundamentally different to PI insurance in that respect. So, as you'll be aware, there's various types of occurrence-based insurance that are available to policyholders. That can include things like public liability insurance, property damage, and product liability, amongst others. So, to understand when those types of policies are triggered, it's necessary to understand what is meant by occurrence. And broadly speaking, it's the event which causes the loss in respect of which cover is sought. And in terms of what policy provides cover to a policyholder, it's the policy in force when the occurrence took place, and not the policy that is in force necessarily when the claim is made, and that is the distinction. So we'll come on next to a scenario to try and illustrate the difference between how those two types of policy are triggered. So the scenario is this. Let's assume that in 2016 an architect designed a block of flats, and let's assume that the design had various defects from a fire safety perspective, including, say, that the fire stopping wasn't compliant and the compartmentation of the building wasn't in compliance with the building regs. That's been, I think as some of you may know, that's been quite a common theme post Grenfell. Let's go forward a couple of years to 2020, where you have a roofing contractor who's carrying out some hot works on the roof of the flats. Unfortunately, during the execution of those works, a fire is caused, and that results in the destruction of the building. The fire had spread more quickly through the building than it otherwise should have done, due to the fact it was designed and constructed defectively due to the errors in the architect's design. Again, let's go forward a couple of years. The building owner brings claims against both the architect and the roofing contractor to recover the costs of rebuilding the block of flats. So the claim against the architect would be you've designed the building negligently. The claim against the roofing contractor could be, well, you've executed you've executed the hot works poorly, resulting in the fire. Then let's go forward another couple of years to 2024, where you have the individual flat owners bringing claims against the architect and the roofing contractor to recover the costs of all of due to the fact that their possessions in their flats have been destroyed. So first issue is, well, what policies are engaged? Well, for the architect, it would be their PI insurance, because the claim would arise from negligent performance of professional services. For the roofing contractor, it would be their public liability insurance, which is an occurrence-based policy. So in this scenario, what policy years are engaged? Well, for the architect, for the claim again by the building owner, I think it would be the 2022 year policy, because that was the policy in force when the claim was made against the architect. It doesn't matter that the error in the design took place back in 2016. And for the claim against the architect by the residents, it would be the 2024 policy, because that was again when the claim was made. And again, it doesn't matter that the error in design took place in 2016. Contrast that with the roofing contractor. For both sets of claims, I think it would be the 2020 policy that was in force, and that was because that was would have been the public liability policy in force at the time of the fire, and it's the occurrence of the fire which is what triggers the policy, as opposed to when the claims were made against the roofing contractor. So hopefully that gives an explanation as to why the basis of cover for those two policies are sort of fundamentally different as to the timing of when they're engaged. As I said earlier, PI policies are written on a claims-made basis, but they do allow policyholders to notify circumstances because the claims-made basis of cover just really wouldn't function properly unless there was an ability to notify circumstances. And when a circumstance is notified, it provides an extension of cover such that any claim arising out of that circumstance, even if made many years later, is deemed to be first made during the period of insurance which the notification of circumstance was made. There are broadly two types of circumstance that PI policies allow policyholders to notify. There are those which may give rise to a claim and those that are likely to give rise to a claim. You tend to find that the may wording is more prevalent in policies for sort of accountants and solicitors, whereas likely wording is more common in D&C and architects and engineers wording, and I'll come on to why that is in a minute. So what's the difference between circumstances that may give rise to a claim and those which are likely to give rise to a claim? Well, may is a much lower threshold, and I've mentioned some case law on the screen there which explains what the threshold is. So the Caytons decision, which is well known, says that a circumstance which may give rise to a claim requires that circumstances should be one which, objectively evaluated, creates a reasonable and appreciable possibility that it will give rise to a loss or claim against the insured. And in Rothschild, it made clear that the test of materiality is a weak one. There is quite the word objectively used in the Caytons case is quite important, because when determining whether something is notifiable, the courts look at it on the basis of what would a reasonable person in the insured's shoes think is notifiable. It doesn't matter sort of subjectively what the insured thinks. So if the insured is in doubt, they should sort of seek advice, I would suggest, from yourselves on whether to notify something, and it is best to err on the side of caution. Likely give rise to a claim, clues in the title, I guess, but the circumstance has to be more probable than not that there is going to be a claim arising from it. A reason why in D&C and A&E policies the notification requirement is likely to give rise to a claim is because if you had a may wording, you'd end up having sort of a significant volume of notifications potentially, because you can imagine the amount of things on a project, construction project, that could give rise to a claim. So that's a reason why there is a distinction. It's to do with sort of practicality, really. And I think next we're going to come on to some examples, and we're going to consider whether they are claims or circumstances. So example one, this is an architect's policy. So let's work on the basis that circumstances that are notifiable have to be those which are likely to give rise to a claim. So the example is insured architect intends to pursue outstanding fees that the client hasn't paid. The insured says they don't think that they've done anything wrong, but they are concerned they might get a claim if they pursue their claim for fees. Now, the answer to that at that stage is that it's not a circumstance likely to give rise to a claim, in my view. There might be a hypothetical possibility that the client might make a counterclaim in response to the claim for fees, but that's very much hypothetical at that point in time. The thing to do with that one would be to keep it under review once the insured has sought their outstanding fees, if that's what they want to do. So example 2, again, architect's policy. So let's work on the basis that the policy allows them to notify circumstances that are likely to give rise to a claim. The example is the insured architect was the lead designer across a number of developments. They receive a letter from the solicitors alleging that they were badly designed and remedial works are taking place, but with no specifics. So the answer to that one, I think, is that is a circumstance likely to give rise to a claim. It doesn't quite amount to a claim in my view, because it doesn't quite get into saying that the insured is actually responsible for the cost of the remedial works, or it doesn't demand repayment of costs incurred in remediating the defects. So let's move on to example 3. So it's an accountant's policy. So let's work on the basis that the policy allows them to notify circumstances that may give rise to a claim. So the insured accountant receives a letter of complaint in relation to tax advice, although it doesn't expressly say that the insured is responsible for any loss. Now, I think the answer to that one is that is a circumstance that may give rise to a claim. It doesn't assert that the insured is responsible for loss, but there's sufficient scope for a reasonable person to consider that a claim might come, because after all, if tax advice given is incorrect, then it's not unreasonable to assume that some loss might have been suffered as a result of that. Example 4 is an accountant receives a letter of claim sent under the pre-action protocol. Well, clearly the answer to that one is that is a claim. Example 5, going back to architects, again, circumstances likely to give rise to a claim would be the notification threshold for circumstances. The example is an architect receives a letter explaining there is a problem with a building due to its design, coupled with a request that they undertake some remedial design work. Well, I think that is at least going to be a circumstance likely to give rise to a claim, but also notes that often in A&E policies and contractors policies that there can be a cover for mitigation of loss, which allows to insured to incur costs in order to mitigate the scope for a wider claim. So if you're faced with that scenario, they do get that notified, particularly if the insured is going to be looking to engage the mitigation cover. And just as a general point on these, if there is any doubt about whether something is notifiable, it is best to notify it. If insurers take the view something isn't notifiable, then that's their call. But it does avoid policyholders falling foul of notification requirements and can avoid sort of coverage disputes, I would suggest. So we've covered how policies work when they're in force as regards how they're triggered, whether matters amounts to claims or circumstances. But before you get to a position of having a policy of insurance in place, as you'll be aware, there is an underwriting process where insurers will consider the risk and decide whether to issue a policy. Now, since the coming into force of the Insurance Act of 2015, the prospective policyholders at that point have been under a duty to provide to insurers a fair presentation of the risk, and that requires them to disclose material circumstances, which in essence are those that a prudent underwriter would consider material in determining whether to offer terms, and if so, what those terms will be. Compliance with that duty is fundamentally important to insurers' from insurers' perspective for a number of reasons, which I've listed on the slide there. So It allows them to assess the risk profile of the insured. It allows them to determine what the appropriate premium for the risk will be. It will allow them to determine what terms to offer. It might be that they look to apply specific exclusions if there are known issues, say with projects, or possibly fire safety exclusions, as has been common in recent years. Complying with the duty and making sure clients understand what is expected of them also helps avoid coverage disputes in the event that there is a notification. Whilst the Insurance Act has sort of softened or restricted insurers' rights as to what they could do for, in many respects, if there had been a breach of policy terms or a failure to disclose something prior to the inception of the policy, there are still quite significant remedies available to insurers if there has been a breach of the duty of fair presentation, because it is so fundamental to what they are doing. So if the breach is by the policy holder is deliberate or reckless, the insurers can avoid the policy and keep the premium, which is a very, very significant remedy. If it's innocent, so non-deliberate or reckless, then the insurers still have remedies. If they would not have entered the policy on any terms but for the breach, they can avoid the policy, but they have to give back the premium. If the insurers would have applied different terms, then they can treat the policy as being on those different terms. If the insurers would have charged a higher premium, then they don't just get the extra premium that they would have charged. It's sort of more significant than that. What they can do is reduce proportionately the amounts they pay on a claim. So say the premium charge was 100,000 and they would have charged an extra 50,000, so it's an increase of 50%. If the insured had a claim for £1 million, they could reduce what they pay on that by 50%, so to half a million. So it is important that policyholders understand, well, one, the significance of the duty of fair presentation, and what the remedies are in the event that they don't comply with that. Just on this issue, disclosure on proposal forms of possible circumstances does not amount to a notification of circumstances or claims under an existing policy. The fair presentation process is not relevant to existing policies. It is only relevant to policies that are going to incept in the future. So if in the course of presenting a risk to an insurer, it becomes apparent that there has been a problem and a notification needs to be made, make sure that you comply with the notification requirements under the existing policy to get that notified, to avoid coverage issues. Practically speaking, what will happen is that notification under the existing policy will go to the claims team, and the claims specialist will deal with that. Whereas the process of presenting the risk is to underwriters and not to the claims people. So there is quite a fundamental distinction there. So just some key takeaways from the points I've discussed. So under claims made policies, it is the time the claim that is made which determines which policy responds. There is a caveat to that, which is that PI policies allow circumstances to be notified and which provide an extension of cover, such that if a claim is subsequently made in another year and it arises out of that circumstances, it is deemed to be made in the earlier policy period. On sort of issues of whether to notify something under a current policy, it is best to err on the side of caution to avoid coverage issues. And finally, compliance with the duty of fair presentation, very, very important from insurers' perspective. And if clients understand that, then that would be a real benefit. And disclosure of circumstances on proposal forms for a new policy doesn't amount to a notification under an existing policy. So just bear that in mind. So I think that concludes what I've got to say, but we do have some time for questions to the extent there are any.
And just if anybody does have any questions, please either pop them in the chat or you can turn on your microphone. But just as a reminder of the notification requirements under all of the NBS PI policy wordings, notification does need to be made of any claims or circumstances directly to Caytons, who handle all our claims. So you can email claims@caytonslaw.com with any claims and circumstance notifications. Do we have any questions? If you do think of any questions after the event, then please do get in contact. Be happy to answer those, and we'll pass those on to Sam. If there's not any questions now, thank you very much for joining us. I hope you found the session useful and that it's provided some practical insight into the way that professional indemnity insurance operates.
Thank you, Teresa, and thank you all for listening. Thanks.